If you have exactly $10,000 of credit card debt and you're making the minimum payment right now, I want to show you a math problem that will make your blood run cold. You get your statement. The minimum payment is $200. You pay the $200, you immediately feel responsible, you check the box, you did what the bank asked. But let's look at where that $200 actually goes. Out of that single payment, $183 goes straight into the furnace of credit card interest. Only $17 goes toward actually paying down your debt. At that exact pace, paying the minimum every single month, it is going to take you over 27 years to pay off a $10,000 balance. You will end up paying over $16,000 in interest alone for the privilege of carrying that debt. For 27 entire years. That's a mortgage timeline for a piece of plastic. It is a financial hamster wheel, where the faster you run, the further behind you actually get. My name is Nick, and I create easy-to-understand animated videos about personal finance. If that's something that interests you, consider subscribing. Today we're going to talk about a phenomenon I call the $10,000 gravity well. If you have $10,000 in consumer debt, whether it's on a high-interest credit card, a personal loan, or an underwater car loan, you're not just losing money every month. You are mathematically being crushed by an invisible force that is dictating every single decision you make in your life. Banks understand this gravity well perfectly. It is the core of their entire business model, but they have absolutely zero incentive to explain it to you. The financial industry profits immensely from keeping this obscure, and the entire system relies on you being far too exhausted from working 40 to 50 hours a week to sit down and do this math. But by the end of this video, you're going to understand exactly why crossing back over the zero line, paying off that first $10,000 of high-interest debt, changes literally everything about your financial trajectory. We're going to cover the exact math behind how the system bleeds you dry, what it actually costs you in daily dollars, and a 3-step plan to break out of the trap starting this weekend. To understand why this happens, we need to look at what's actually happening to the middle class right now. According to a massive 2026 survey by the National Endowment for Financial Education, 88% of American adults started this year feeling significant daily financial stress. Think about that number for a second. Almost 9 out of 10 people you pass on the street are quietly panicked about money. 77% experienced a major financial setback last year. An exhaustive research out of Harvard, specifically the famous studies on middle-class bankruptcy conducted by Elizabeth Warren and Amelia Warren Tyagi, proves that it's not because people are buying too many $6 lattes or wasting money on avocado toast. The Harvard study examined thousands of middle-class bankruptcy cases and found that nearly 90% of all middle-class bankruptcies are caused by just 3 life events: job loss, major medical problems, or a family breakup like divorce. Now here's the part that really stings. In the 1970s, a single-income family could afford a house, a car, groceries, and still have a financial buffer for the unexpected. If the primary earner lost their job, the stay-at-home parent could enter the workforce to bridge the gap. That was the American safety net. Today, that safety net completely vanished. Warren calls it the 2-income trap. Families now require 2 full-time, heavily taxed incomes just to cover the basic fixed costs of modern life: housing in a decent school district, skyrocketing childcare, and mandatory health insurance premiums. Both parents are working, both incomes are locked in, the buffer is gone. When those inevitable life emergencies hit today, families have absolutely nowhere to turn. So they reach for the ultimate false safety net: plastic. Right now, the average American household owes over $11,000 strictly in revolving credit card debt. Total U.S. household debt has hit an all-time record of $18.8 trillion. And as of 2026, the average interest rate on credit cards is hovering around terrifyingly high levels, roughly 22%. That is the highest rate we have seen in decades. But here's where the math gets really interesting. And by interesting, I mean absolutely terrifying. Let's break down exactly what having $10,000 in debt at 22% interest actually means on a daily, visceral basis. 22% of $10,000 is $2,200 a year in interest. If we divide that $2,200 by 365 days, that comes out to slightly over $6 a day. Every single day you wake up with that debt, before you've had a cup of coffee or turned the key in your car's ignition, you're being charged $6. Just for existing. It's $42 a week, roughly $183 a month. That is not paying off anything you bought. That is a massive subscription service to your own poverty. Let me put this differently. If someone told you they were spending $183 every single month on a streaming service they literally never watched, you'd think they were out of their mind. You'd stage an intervention. But somehow, when it's interest on a credit card balance, we just nod our heads and accept it as a normal, responsible part of being a functioning adult in America. Now, you might be watching this and thinking, look, I make pretty decent money. A couple $100 a month isn't ruining my life. I can handle the payments. Let's test that theory. Let's meet a household we'll call the Garcias. The Garcias are two working professionals pulling in a combined $65,000 a year. That puts them squarely in the true American middle class. Both of them get up at 6 in the morning and commute an hour each way to their jobs. They are doing everything society told them to do. They should be perfectly comfortable, right? Let's watch what happens when we run their lifestyle through the brutal blender of actual math. Their gross income is roughly $5,400 a month. Sounds respectable. Sounds stable. Until the IRS shows up. Very quickly, the government steps in, taking federal taxes, state taxes, and FICA contributions. Now their actual take-home pay immediately shrinks to $4,225. Rent for a modest two-bedroom apartment in a safe neighborhood takes $1,500 right off the top. They are instantly down to $2,725. They need to get to their jobs, so they have two totally average, non-luxury used car payments for a combined $550 a month. Now they're at $2,175. Car insurance for those two vehicles runs them $200 a month. We're at $1,975. Gas to commute back and forth to work, 5 days a week, takes another $250, $1,725 remaining. Groceries to feed their family, and we are talking basic meals here, not organic stakeouts or even regular takeout, runs them $700 a month. Now they're sitting at $1,025. Utilities, two cell phone plans so their bosses can reach them at all hours, and barely functional home internet / another $350, down to $675. They each have a small student loan payment from their state college degrees, totaling $300, $375 left. And finally, there's the minimum payment on their $10,000 of accumulated medical and emergency credit card debt. That's $200. The Garcias, a hardworking American family making $65,000 a year, working 80 combined hours a week between the two of them, have exactly $175 left over at the absolute end of the month. That is precisely $43.75 a week of breathing room. And I am not done yet. Notice what I haven't subtracted from this equation. I haven't subtracted clothing or shoes for their growing kids. I haven't subtracted a single medical copay, a single prescription, or a single dental cleaning. I haven't subtracted occasional car maintenance, like a surprise $500 brake job or new tires before winter. I haven't accounted for birthday presents, a single Friday night pizza, a school field trip that costs $20, or the psychological need to occasionally leave the house and pretend they have an actual life. When you have exactly $43 of breathing room a week, you aren't living. You are surviving. And there's a critical difference. This brings us back to the heavy, crushing gravity well of that $10,000 debt. When you are trapped in survival mode, your brain physically and chemically changes. This isn't motivational speaker nonsense. This is peer-reviewed medical research. Studies on financial stress and cortisol, the body's core stress hormone, have shown that carrying chronic, unpayable debt elevates cortisol to dangerously sustained levels. That persistent cortisol flood weakens your immune system, raises your diastolic blood pressure, and literally impairs your brain's capacity for long-term executive planning. A major UK study involving nearly 5,000 adults found that financial strain was associated with the riskiest long-term health profiles, worse even than bereavement or divorce. You develop what psychologists call decision fatigue. It's like trying to plan a luxurious vacation itinerary while your house is actively on fire. Your brain physically rejects it. The only thing you can focus on is the smoke filling your lungs today. You simply cannot think about retirement in 30 years when you're running daily mental calculations about which bill you can afford to pay 2 weeks late without getting the electricity shut off. And here is where the math goes from depressing to incredibly deliberately cruel. When you are broke in America, the system actively charges you more money just for being broke. It's a concept I call the poverty premium. Let's go back to the Garcias. If they get a flat tire that costs $150 and they only have $43 of weekly breathing room, they overdraw their checking account. The bank immediately hits them with a $35 overdraft fee. If they miss their next credit card payment by 2 days because they had to redirect that money to buy groceries for their kids, they immediately get slapped with a $32 late fee. Because their credit utilization ratio is sky high from carrying that $10,000 balance on a $15,000 credit limit, their credit score tanks down into the low 600s. Because their credit score is low, their auto insurance company legally charges them 30% higher monthly premiums than someone with good credit. When they try to move to a cheaper apartment, the new landlord demands a double security deposit, an extra $1,500 they don't have. The average low-income household in America pays over $1,000 a year in poverty premium penalties, overdraft fees, late fees, penalty APR increases, higher insurance premiums, larger deposits. This is wealth destruction with absolute surgical precision. That money evaporates into thin air. It doesn't reduce the principal of their debt by a single penny. They are essentially renting their own financial desperation from the same institutions that created it. But what happens when you decide you've had enough? What happens when you finally break the atmosphere of that $10,000 gravity well and clear the balance to zero? Everything changes. And I mean everything. The entire mathematical equation of your life flips on its head. Let's go back to that minimum payment we started with at the top of this video. The $200 a month you were faithfully throwing into the furnace of credit card interest. When the debt is gone, that $200 does not disappear. It doesn't evaporate. It is suddenly completely yours again. And this is the critical moment where we have to talk about opportunity cost. If you take that exact same $200 a month, money your budget is already completely used to living without, and you invest it into a total stock market S&P 500 index fund, returning an average historical rate of 8% a year, watch what happens. Over 10 years, that $200 a month grows to roughly $36,500. Over 20 years, it compounds to over $117,000. Over 30 years, it explodes to nearly $300,000. Let that math sink in for a moment. That $10,000 of credit card debt isn't just costing you $200 a month right now. That debt is mathematically provably stealing a $300,000 retirement from your future self. You are letting the credit card company rob your 65-year-old self to pay for whatever emergency or lifestyle inflation happened 5 years ago. This is the secret the entire financial industry desperately hopes you never sit down and calculate. They want you intensely, obsessively focused on the monthly payment, not the 30-year opportunity cost. If they can get you to look at the 27-year minimum payment timeline as quote-unquote manageable, they win. Because as long as you make the monthly payment, you are funding their quarterly profit reports, building their shareholders' wealth, and ensuring their executives get massive year-end bonuses. All while you wonder why you can't retire. So, how do we fix it? How do you actually escape the $10,000 trap when your budget already feels impossibly, suffocatingly tight? You need a systematic, aggressive approach, and you need to deploy it this weekend. Not next month, not after the holidays, this weekend. Here is your exact 3-step blueprint to flip the math. Step 1. You must fundamentally change your payment structure. I don't care what the paper statement says your minimum payment is. You are going to permanently, aggressively ignore that number. We already proved beyond any doubt that a $200 minimum payment takes 27 agonizing years to pay off a $10,000 balance and costs you $26,000 total. If you can squeeze your budget, sell some things collecting dust in your garage, drive for Uber or DoorDash on weekends, cancel every streaming subscription you hold, stop buying lunch at work, and aggressively throw $400 a month at that debt, double the minimum, the entire timeline collapses. At a fixed $400 a month, that 22% APR debt is completely gone in roughly 34 months. That is under 3 years. Instead of paying $16,000 in interest over 3 decades, you pay about $3,400 in interest over 3 years. By simply doubling the payment, you automatically save yourself over $12,000 in pure interest, and you buy back 24 entire years of your life. That's not a small optimization. That is a completely different financial reality. Step 2. You need a fast psychological victory, which means you must deploy the debt snowball method. Now, if you ask any math professor, they will logically tell you to pay off the balance with the absolute highest interest rate first. That's called the debt avalanche method, and mathematically, yes, it saves a small fraction more money in the long run. But here's the thing. A major, definitive study published in the Journal of Consumer Research proved conclusively that human beings are not spreadsheets. We are deeply emotional creatures. The study found that people who use the debt snowball method, which means paying off their smallest balances first regardless of the interest rate, are significantly more likely to actually finish paying off all of their debts. Why? Dopamine. When you aggressively clear out a trailing $500 medical bill or a tiny $700 store credit card in just 2 months, your brain gets a massive, addictive hit of dopamine. You cross a line off a piece of paper, you close an account, you feel a surge of power and control you probably haven't felt in years. You take that momentum, take the freed up payment from the eliminated debt, roll it into the next smallest balance, and you build a self-sustaining psychological machine that is immune to burnout. Each victory fuels the next one. Step 3. You must immediately weaponize your credit score increase. When you start systematically destroying that $10,000 in revolving credit card debt, your overall credit utilization ratio plummets. Credit utilization, how much of your available credit you're using, accounts for roughly 30% of your entire FICO score. When your utilization drops below 30%, the three major credit bureaus react extremely aggressively. When it drops below 10%, they reward you even more. It is incredibly consistently common to see an average consumer's credit score jump 30, 40, or even 50 points in a matter of just a few short months after a major credit card payoff. And here's why that matters in real dollars and cents. When your score finally crosses into the mid-700s, you suddenly have real, tangible economic power. You can take that new score and refinance an underwater car loan from 12% interest down to 5 or 6%, instantly saving yourself thousands of dollars over the life of the loan. You can call your auto insurance company, and your monthly premiums will drop because their actuaries statistically view high credit score drivers as significantly lower risk. You can negotiate better terms on literally everything. You officially stop paying the poverty premium, and you start receiving the compounding invisible benefits of the ownership class. Now, here's what this actually means for your daily life. If you are carrying $10,000 in debt right now, I know exactly what that feels like. I know because I've heard from thousands of you. It feels like checking your bank account on your phone in the grocery store parking lot before you actually walk inside, just to make sure the debit card won't decline at the register in front of the person behind you. It feels like saying no to dinner with your oldest friends, because that $50 might be violently necessary tomorrow morning if that weird rattling sound in your car actually turns into a real problem. It feels like lying awake at 2 a.m. staring at the ceiling doing mental math, terrified that one bad piece of mail, one car repair, one anything, is going to completely derail your life. It feels like being one unexpected expense away from absolute disaster at all times. Sound familiar? Listen to me very carefully. This is not your fault. You weren't supposed to casually figure this out on your own while simultaneously working a full-time job, raising kids, and trying to keep the lights on. Financial literacy is deliberately not taught in schools because the people who profit from your confusion wrote the curriculum. The system was meticulously designed to get you into the trap, not to ensure you could comfortably afford your actual life. Nobody in the transaction, not the bank, not the credit card company, not the car dealer, not the mortgage lender, has any financial incentive to tell you that you're about to mathematically drown yourself. They are all selling you a product, but now you know the math they use against you. And more importantly, you know exactly what changing that math actually looks like. Suddenly, giving up a few small luxuries, cooking at home instead of ordering delivery, or driving an older, reliable used car doesn't feel like deprivation or sacrifice anymore. It feels like a strategic, highly calculated choice that is directly funding your future freedom. That reliable used car in your driveway isn't looking so bad after all when you realize it's the vehicle carrying you toward a $300,000 retirement fund. The real win isn't looking rich today. The real win is making decisions based on reality rather than social pressure, on math rather than emotion, on your own financial future rather than a credit card company's quarterly earnings report. If this video opened your eyes to how the math really works, click the subscribe button. We tear apart financial traps exactly like this every single week. Now take your budget, find that $400, and start breaking the atmosphere.